In this thrilling installment of the Dapper Dividends YouTube channel, we're going to tell you all about the 13 dividend checks that we received in April for over $800. And I'd like to introduce you to a stock that, if you've done any kind of tagging, home improvement, or been to a hardware store, you know what Rust-Oleum is. So we're going to put that company on your radar. But before we do, remember that you can always follow along with the portfolio moves and activity on getquin.com, which is linked below. And also, if you head on over to dapperdividends.com, you can sign up for the fabulous, fantastic, and free weekly newsletter recapping all the portfolio activity. And let us know in the comments below, because you know where the comments go, the business that paid you the most significant dividend check in the month of April. In the month of April, Leggett & Platt, ticker LEG, paid us $46. This is one that I probably should have gotten out of sooner, but this is the price you pay for a cyclical business. And we're in a down cycle now, and man, have they paid the price, hoping that they can get through this with the dividend intact. One of our core positions, PepsiCo, ticker PEP, paid us a dividend of $126.50. They're just a blue chipper that I'm not expecting a lot of growth from, but just to keep paying those solid and stable growing dividends. High-flying defense contractor Lockheed Martin paid us $31.50. We have not added any Lockheed Martin shares in years. We just continue to hang on to the 10 shares that we do have and collect those dividend checks. Our first of two BDCs to give us a dividend check was Ares Capital, ticker ARCC, which we have across two of the portfolios we share, paid us $194.40 in dividends in the month of April. They're very similar to our next dividend paying company, which is very spread out, diversifying some of the credit risk that they take on the money they loan out, is Main Street Capital, ticker MAIN, paid us $36 in dividends for the month of April. Now, this is a monthly dividend paying stock, and look at all those special dividends that they have recently paid in a bunch of consecutive quarters. We go from one monthly paying dividend stock to another, Realty Income, ticker O. They are the monthly dividend company, and they paid us $51.40. And we have about 200 shares in Realty Income. We're not going to start adding to them just yet because we're trying to build out our position of Agree Realty, ticker ADC, which paid us $7.66. Now, that is also a monthly dividend paying stock. So that's given us Realty Income, Main Street Capital, and Agree Realty all in the self-directed IRA, which is tax advantaged. We have those there strategically, so we don't have to pay taxes on the dividends yet. But ADC reminds me of a little brother to Realty Income, and I think they have a lot more growth potential ahead of them than does the big, giant gorilla in the room, 800-pound gorilla, I think they say that Realty Income is. So ADC, you're getting the potential growth and the monthly dividends to boot. And yet another REIT, ticker VICI, Vici Properties. If you've been to Vegas, they own about half of the Vegas Strip, maybe a little more. We really like them. They're trying to expand. Big fan of the CEO, Ed Pitoniak, wants to expand into more experiential family things, more sporting events, things of that nature. So getting a little bit away from gambling, but still trying to stay in that space of entertainment. And they paid us $54.37. So Diageo, ticker DEO, we only owned 4 shares of. Yes, I say owned because we sold out of them because we only had those 4 shares, hadn't been adding in a while, and it just kind of felt like a spring cleaning time. Sometimes it's okay as investors. We can buy a position, try it on for size, take it out for a spin, test drive it, see if we like it. And for me, I may have gotten a little bit ahead of myself, just wanting to own the business that produces one of my favorite alcoholic beverages, Guinness. While they are a good company, again, facing some headwinds, and I don't think that they're going to have significant share price growth. Innovative Industrial Properties, another REIT, ticker IIPR. This one, $18.20, very well-run business, but I think that there is a lot of sector headwinds that could be facing them when regulation does happen. So this is one that, because I can't reliably guesstimate the future, we want to move out of that position, but really good management team. Just unfortunately, I think that there may be some things coming down the pike that management may have some trouble dealing with. Simon Property Group, ticker SPG, paid us $19.50. They are kind of the higher end outlet mall REIT. If you're in the Chicagoland area, you may have seen Gurney Mills. If you're in southern Wisconsin, the Pleasant Prairie outlet malls. While you're there, check out the Pepperidge Farm store. You get some really good deals, and they also have the Converse Clearance Center. We haven't been adding much to them. I think they are a little bit overvalued right now, but still a good REIT. And we go north of the border to Toronto for Toronto Dominion Bank, ticker TD, paid us $112.69. We like TD because they're a little bit more conservatively run. They don't take a lot of risks that some of the other banks do, but all the Canadian banks look pretty solid. We just, personal reasons, decided to go with TD. And then last, Big Mo paid us $124.46, which is Altria. We're slowly going to scale out of them. Actually, we just sold a covered call at $44 that expires in early May. And if we get called away, that's the way we're going to do it, because I think, as I've shared with a lot of you, that I have a bit of an addiction to the Altria dividends, and I'm really trying to kick the habit by selling out little bits here and there, but I may just have to go cold turkey. Love the dividend, but I think they are a stagnant business. Cigarette sales are declining. I don't know if the vaping and the new products, the next gen products, tobacco products, are going to be able to fill the gap that cigarettes is starting to leave. And they're not going to be able to raise prices forever. You're going to hit a point where people probably aren't going to pay $60 or $70 for a pack of smokes. So that was for a grand total of $835.64 in dividends in the month of April. Yeah. And now for the stock to put on your radar. It is the manufacturer, the owner of Rust-Oleum, is ticker RPM International, which makes all kinds of coatings, sealants, and the building materials used in construction and home improvement. They've been around for 70 years, and they own brands like the Rust-Oleum paint I showed you, Dap Caulk, and tons of other brands that you have seen all around the home improvement stores. Some of RPM's main strengths are their broad product lineup, leading market positions in many categories, and they have a bit of a Berkshire-type growth strategy of acquiring successful smaller companies. And some of the challenges they face are rising raw material costs that can squeeze their profit margins, successfully integrating all of the companies they acquire, and competing against lower price competitors. But overall, they are just a really well-established player in the building materials industry. And we'll just do a very quick look-see here. They get a dividend safety score of 64, yield currently of 1.72%. Again, I just happened to come across them by looking at the Rust-Oleum can and saying, hey, who makes them, Google? Now, RPM is a dividend king. Their last raise was 9.5% in October of 23, and they have a 6% 20-year CAGR, currently hitting you with $1.84 of dividends per share every year. But that yield of 1.72% is about 6% below the 5-year average, and their forward price-to-earnings ratio is about in line. And a fun thing about the PE here, the price-to-earnings ratio, when you see this 20.0 in the forward, kind of tells you can guesstimate how long it would take you to get your initial investment back. So right there, you're looking at about 20 years. Now we'll go through these metrics really quickly. So if you want to take a better look, pause the video. Free cash flow payout ratio is 22%, so it's very low, but you can see they've had some issues with free cash flow in the past. A little bit of cyclicality there, causing some of those air pockets that cause negative free cash and lower free cash flow than normal. But earnings per share keep going up and to the right. Sales growth usually is good at about 5% or greater, except for those pockets where it's not. Down to 128 million shares outstanding. The total sales, you gotta see that revenue. Revenue is so important. You have to see that keep coming up, because while they can do financial engineering, cost cutting and things, it's gonna be really difficult to do that if the revenue coming in is stagnating. So very nice trend to see that their sales keep going up and to the right. And I think their margins look healthy. 25% ROE, 17% return on invested capital, very nice numbers. And the debt was a little bit high, but it looks like it's starting to come down. Currently 49% of net debt to capital, but net debt to EBITDA 1.93 times the last 12 months, so that's pretty low. If you don't know what that means, when you see net debt to the earnings before interest, taxes, depreciation, and amortization, which, yes, Mr. Munger called BS earnings. Either way, for this exercise, when they see this 1.93, it means it will take about 1.93 years of EBITDA to pay back and cover the net debt. And the interest coverage ratio, which is simply how much operating income does a business have to cover every $1 of their interest expense, currently 6.82. So RPM has $6.82 of operating income to cover every $1 pretty comfortably of interest expense. My liking is I want to see that number over 5 to give them some wiggle room. On seekingalpha.com, which if you wanted to get a premium subscription, I always have that perpetual affiliate link in the notes below where you can save yourself a few bucks. Most of the analysts give this a hold, couple have a buy, factor grades, valuation D-, so it is looking a little overvalued. And alphaspread.com will show you their guesstimate of an intrinsic value. Remember, it's just a range. When you see this 0.65, you can't do that, but they just give a number anyway. So just remember, intrinsic value is a range. It's not a to 2 decimal place exact number, but they give an intrinsic value on the base case of $97.65, which is overvalued as of this recording about 9%. If you wanted to do a worst case, which I think is 5 years of negative growth, $77. So the biggest margin of safety that you could comfortably give yourself. Wait for the high 70s, low 80s with RPM, as that's kind of what I'm doing. If it gets down there, I may actually consider starting a position. So please be sure to share with all of us in the comments below if you were aware of RPM International, if you've looked at them before, or if you even own them. We would like to know. And in this floating little box next to my head, if you're all about getting stock ideas like we just looked at with RPM, click on that little box. I've got some more for you in that video, and if you do click that little box, then I will talk to you there.